Welcome to MarketTamer.com. You're looking at a spreadsheet of the bear call calculator, and the reason we're looking at this is specifically to address a member's question regarding how and when some of these numbers here change when we change some of the numbers over here. So the first thing to note is we are looking at a bear call, and that means we care about short call credits and long call debits. Now, given that we care about a short call credit, we'll start over here with the short call and move to the bid price. And let's just assume that the bid price in a trade we're considering is $2.80. And for completeness, we'll add the ask price. We'll say it's $2.90. And let's say in the long call, it's costing us, let's say it's costing us $1.50 to purchase that. And we'll add the bid price here for completeness again. So what's happened? Well, the net credit before commissions has changed, and just to highlight that, let's change one of these numbers just to note again what happens. Again, this net credit before commissions figure changes once we change these critical criteria, the short call bid price and the long call ask price. Note also the effect here of contract numbers. For example, if we're trading 10 contracts, you can see the commissions at trade entry is 2 cents here. But let's, for example, say we were trading just one contract. Well, now you can see how much the commissions at trade entry per share represents, and in fact it's a substantial hit on the overall net credit. In fact, if you were trading at a full service broker, and let's say your commission costs were higher, let's just say it was 30 and 30 and 30 again and 30 again, so that is $30 commission at trade entry, $30 at trade exit for each of the legs. Then note how substantial this commission's cost is relative to the overall credit you're receiving in the trade. And that tells you to be pretty darn cautious about the overall contract numbers and commissions in the trade. So let's just increase this back up to 2 here. We see a big reduction here from 60 cents to 30 cents. If we increase the contract numbers to 5, we can see it drop down to about 12 cents and up to 10. We can see what happens here. So definitely pay attention to that, because what really counts is the money that ends up in your pocket at the end, and that is the net credit after commissions, which is in this case $1.14. That's also the target exit point. You can also play around with figures such as the deltas, so that you know how much the bear call is going to profit for a $1 change in stock. That is if the stock is dropping. Conversely, if the stock is rising, you know how much that's going to impact the bear call detrimentally. And we've also added a few figures over here, such as the dollar amount of the target profit, as well as maximum risk and theoretical break even. The bear call delta you see is minus 0.25. That's just the sum of these two numbers, minus 0.5 on the short call and the long call with a positive delta. And obviously that's what we would expect, that the short call optimizes bearish trend, so we have the negative delta. The long call optimizes bullish trend, so we have the positive delta. We also know in a bear call, the short call strike price here is 50, the long call strike is higher, so that explains why we see minus 0.5 or on an absolute basis, that is if we were to consider an all positive delta figures between short call and long call, we see on an absolute basis the short call is higher, but in practical terms what it means is a more negative short call delta than a positive long call delta. So if you have any questions on anything that we've covered here, please don't hesitate to jump into class, ask questions there, or indeed post your questions on the forum section at MarketTamer.com. and we'll look forward to answering them there. Thanks so much and have a wonderful weekend.